Welcome to the weekly intermarket analysis video update. And in this video, I go through a number of different areas. This is being prepared for Monday, April 21st. The first area that we go through is historical and forward-looking valuation, mainly of the S&P 500. We also go through growth versus value, and we're seeing some changes there. Then I go through a brief section on inflation, mainly as it applies to commodities. Then we look at some other markets that are outside of the stock market itself that we look at once a week just to see if anything is happening there. And then we go through the 11 sectors that make up the S&P, and then we look at some different indexes and as they apply to the S&P itself. And then we look at correlations between different types of financial instruments. Then we look at some long-term trends near the end, and then I go through to sum this up with a list of those things that are positive and those things that are negative. And we are seeing some changes as the market's been going through a pretty difficult time in 2025. The first area is valuation. This is historical. So this looks back at what's already been reported as far as earnings. And then we take the earnings and do a ratio with price of the S&P. And this comes up with a scale anywhere from 10 to 15 to 20. Well, when we're above 20, that means the market is expensive. I have the different levels listed here. And even though we've been coming down, we're still well above this red dashed line. We would have to fall to about 4,200 right now just to get down to the expensive level on a historical basis. To make it a little easier to see, I take the price of the S&P and then the red dashed line here, and we're well above zero, even though we have been coming down. This is that same thing, but it goes all the way back to 1980 with different events that have happened and then what the valuations were at that time. And you can see that we do spend a large part of the time well above the red dash line. So that's not necessarily strange. The market can still go up when it's like that. It just means that it's overvalued and more vulnerable if earnings start to come down because that's what drives stock prices. And we're seeing earnings are still positive, but they're being revised down from higher levels than what we were seeing before. And that's putting some pressure on the index itself. Then a variation of this is the Shiller PE ratio. It looks at the average earnings over a 10-year period of time. And we're coming in at 32.66 right now. This is a chart to give you some perspective. Also, over the period of this chart, the median and the mean has been between 16 and 17. We're still at 32, even though we're coming down. So this suggests that we're also overvalued. But the market looks forward, and these are the forward-looking PE ratios, and they've been coming down. They're getting a little more reasonable. Now, the pink line here, or purple, I'm not sure what that is. These are the Mega Cap 8 or the Magnificent 7 or the Illustrious 11, whatever you want to call them. They're coming down. They've been under pressure, and you're going to see later on that the Mega Cap ETFs and the big stocks, they're really coming under some pressure lately, and that's pushing all these indexes down. That also pushes the forward-looking PE ratio down, and then revising earnings that haven't come out yet, those get revised down. And so you put all that together and you have a declining line. But still, we're coming in above 22. So that's still above that 20 level. The S&P is getting more fairly priced. It's finally dropped under 20, and now it's coming in at 19, still at the high end of the fairly priced range, but it has been coming down. Now, you look down even a little bit more and you see the mid caps and the small caps. The mid caps are coming in at 13.8 and the small caps are coming in at 13.2. From a pure valuation perspective, you would choose small and mid caps, but they're doing really lousy right now. So if you apply technical analysis to this, you probably would avoid the small caps and the mid caps, and you're probably even avoiding the S&P right now since we're in a downtrend. But we don't use this to make decisions. Because we can ride these waves well above the PE ratio of 20 for a long time. It's just when the market starts to get under pressure, we start to hear more about this idea that the market is overvalued. And then it seems to justify prices going down. Then we look at growth versus value, and we're starting to see something here. For a long time, going back to the end of 2023, growth, if you look at it all by itself, it has been in an uptrend. We're starting to cross below. This is generating what we call a death cross, and growth by itself is now in a downtrend and hanging on to an uptrend. Value, it's also been getting hit. It, even though value is outperforming growth right now, and you'll see that through the charts that I have after this, it doesn't mean that value is doing all that well. It just means that it's going down less, and it's still hanging on to an uptrend for right now. Now, where we get some insight is when we look at ratios between the two. Now, this growth to value ratio is really weakening, but it's still positive. Then I do an inverse of that, showing how value has been really coming on strong lately compared to growth. Then we look at some other areas, these indexes here. We're actually seeing a death cross. This is showing that now growth is in a downtrend when compared to value. Here's another inverse showing how value is now in an uptrend compared to growth. Another ETF, we're getting really close to a cross here, and this would be more negative with the blue line crossing below the red line. And we're not quite there, but we're really coming on strong with value starting to outperform growth. And this is what a market does when it's getting ready to be defensive, because there are money managers out there that they have to be involved in the stock market. They can't go to cash. They can't jump over to the bond market. They can't jump into cryptos. They have to stay. It's according to their mandate if they're a hedge fund, or their prospectus if they're a mutual fund, or they have rules with their ETF. They just can't willy-nilly around. They have rules that they have to abide by. And if they're concerned that the market's going to go down, they're going to switch from one area of the stock market to another area of the stock market that may not go up, but it may go down less than some of the more growth areas. And that's what we're seeing here. There's another growth to value ratio, not quite in a downtrend yet, but really showing some weakness. I showed this in the daily video. This is a growth ETF with a ratio of a value ETF coming down below the rainbow. Then this is that same ratio, only inverted, where value is really starting to outperform growth. We then look at the mid caps here, where we're under the 50-day moving average, but still above the 200-day moving average. But this is still showing weakness. Small caps, they had been coming on, but over the last few sessions, they've been falling back. And then this is the one that we pay attention to the most because it's the S&P growth to value ratio. It's actually in a downtrend now. And we look at some inflation gauges. This is a monthly chart of the CRB index, which are commodities, and it's coming down, but we're still seeing the red line having a tendency to go up. Then we look at a ratio between inflation and deflation down here. It's below the red line. The red line's still going down, but we have been bouncing back up recently. But this is not really suggesting that inflation is a problem. It's just kind of peaking up a little bit right now on a longer term basis. Then we look at a daily chart of the CRB index itself, where it is in an uptrend, but it's been getting whacked around with everything else lately too. And then this is the Baltic Dry Index, kind of a pseudo inflation gauge. When it's really going up, that's when people were more concerned about inflation. Well, now it's starting to come back down. And then we look at inflation expectations, which really have been declining since the beginning of 2025, according to this ETF. And then we do a ratio between the inflation expectations, which I just showed, and tips, which do adjust for inflation. And this also seems to be going down with the ratio. Then we look at aluminum and other markets that we really don't deal with on a day in and day out basis. I just look at them once a week in this video, where aluminum is in a downtrend. That's not inflationary. Corn is in an uptrend. That could be inflationary. Wheat is it's really hard to see, but it's barely in an uptrend right now. And then we look at fertilizer. This is a long-term chart where we really spiked up in late 2021 into 2022, came back down. We're starting to go back up a little bit here. Not a real big concern, but still, if this keeps going up, that would be more inflationary. Lumber has been in an uptrend, but recently pulling back. That could be inflationary if it starts to go back up. Oil, which really has been going down. It's in a downtrend right now. We were into the low 60s, and now we're more into the mid 60s. We look at a ratio between gold and oil. Gold's just been setting new all-time highs and really doing well. So that's why this ratio is going up. We want to keep an eye on diesel, which has been coming down a bit. That doesn't appear to be inflationary. And we have gas, which is just kind of chopping all around here, and it's just barely in an uptrend right now. Heating oil is in an actual downtrend. Natural gas is in an uptrend, but really pulling back currently. And then we look at a ratio of copper to gold, and this has really been going down lately. And this ratio continues to fall as gold is going up. Even though copper is doing okay by itself, gold is outperforming. This is copper right here, where we are in an uptrend. And every time I do this video, I say this when we're in an uptrend, copper is a barometer of the economy. And if the copper market was really worried about the economy, I mean, we've taken some hits here, but it's still in an uptrend. It's recovering from these lower prices, and the lines are still going up here. That means that the copper market, anyway, thinks that things are going to be okay with the economy going forward. Then we look at a copper to gold ratio long term. And for the last couple of years now, usually the red line, which is the 10-year yield, the green line is the 2-year yield. These have a tendency to move in the same direction. Well, there's been this really strong disconnect. You would think if the copper to gold ratio is going down, that these rates would be going down too, but that's not what we're seeing here. And I'm not quite sure what to make of this. It just means that we're shifting with the overall economic climate. Gold just coming off of setting an all-time high. This is the ETF, not the futures price. And silver is also in an uptrend, but it still has a ways to go to get back to its all-time high. We look at gold up here, that's the closing price, and silver, and we see that there's a pretty strong correlation between them, which only makes sense. You say silver and gold together, and they have a tendency to move in the same basic direction at the same time, either up or down. Then we're seeing a real disconnect here. When this is going up, the top chart, that means gold is outperforming silver, which it's doing. And then we look at the US dollar index, which has really been under pressure and starting to fall under 100. And now, most of the time, you can see the correlation here where they have a tendency to go in the same direction at the same time. Right now, they're going in opposite directions. So the top chart and the middle chart are moving. If one's going up, the other one's going down, and vice versa. And that's a strange environment that we're in. And things are really kind of crazy right now. Excuse me. The dollar index, now we're in a downtrend here. We actually crossed below 100. The euro is starting to go into an uptrend when we compare it to the dollar. We also see the Japanese yen, the euro, and the dollar all here on one chart, where both the yen and the euro are in uptrends now with the dollar. This shows it as a breakout chart where the euro just crossed over just recently, and it's really been strong when you compare it to the dollar. The Japanese yen is also in an uptrend to the dollar, and the British pound. After a lot of weakness, it's starting to resume that uptrend as well. Then we look at some index ratios, and there's times when I show this chart in every daily video. I've been dropping it because the market's been so crazy lately. The bar chart is the weighted version of the S&P, and that's the one that you probably hear about. Well, to make it a little more fair, there's a red line here, which is the equal weight version of the S&P, where all stocks are treated the same. And we see that there's not really a big disconnect between the two right now. When we're really positive, quite often the red line will be above the bar chart. And when we're more negative, the red line will be below the bar chart. We're seeing them a little bit below right now, but not much. Then we look at a ratio between the equal weight and weighted version of the S&P, and it's really been chopping around a lot. We're not really getting a lot of insight from this. That's why I haven't really been showing these charts in the daily videos. We look at a ratio between stocks and commodities. This is going down. That means stocks are underperforming commodities. This is an inverse showing how commodities are now in an uptrend compared to stocks on a ratio basis. The S&P 100 is really underperforming the S&P 500, and those are the big stocks, the S&P 100. This is showing more weakness in the market. The NASDAQ 100 is underperforming the S&P 500. Now, when we're in a strong bull market and we're really going up, folks tend to prefer the NASDAQ 100, and it really tends to outperform the S&P. When we're going down, this ratio goes down because the S&P holds up better. Where the NASDAQ 100, that's growth. Where the S&P 500 is growth and value, so it's more balanced and there's more stocks in it, so it tends to hold up better, and that's why we're seeing this ratio going down. NASDAQ 100, even though it's in a downtrend, it's actually outperforming the NASDAQ, which has already been in a downtrend. First, we went in a downtrend with the NASDAQ, and then just this past week, we went into a downtrend with the NASDAQ 100. So that's why you see this ratio going up. The bigger stocks are actually holding up a little bit better. The NASDAQ is underperforming the S&P 500. NASDAQ, again, is mostly growth, where the S&P is growth and value. That's why this ratio is going down. And then we look at the mega caps, which are in a downtrend when compared to the equal weight index. That's just showing that this growth to value rotation that we've been seeing. And small caps just are not doing good. They're really underperforming even the S&P, which has been under pressure, but small caps have been going down even more. This is another look at that. The red line is the small cap to S&P ratio. The blue line is the S&P itself. And we're seeing it's not been a good time for small caps. The robotics and AI ETF, that's tech. Well, it's really under a lot of pressure right now. Mega cap growth, starting to see a downtrend here. This has been the real driver of the market going back to late 2022 into early 2023. That's starting to change now. Dow Jones Composite, which is the Dow, the transports and the utilities together. The Dow just went into a downtrend. And when I say downtrend, I mean the 50-period moving average is dropping below the 200-period moving average on a daily chart. Transport's just been really bad. It's the utilities that have been holding this thing up for the most part. Well, now when you take all three of these together, they're now in a downtrend. And then here is another look at the robotics and AI ETF compared to the tech sector. And it's even underperforming as the tech sector has been under pressure. This is another look at an AI and tech ETF. It's still hanging on to an uptrend, but it's a really weak uptrend right now. We've been seeing a lot of pressure here. Semiconductors, this is a real foundation. If you go back here to late 2022 into 2023, it was really the semiconductors that started to lead us up out of that bear market we were in. Well, what's been happening here? Going back into 2024, we're in a downtrend here. And this is just looking at the SOX index. There's a number of different ways to measure semiconductors. Another way is the SMH semiconductor ETF. That's in a downtrend, but you can see it didn't go into a downtrend until we got into 2025. It held up better. And we look at the semi to tech ratio. This is going down. That means the semis are underperforming. In a more solid environment, we want to see this ratio going up. Small caps to tech, both just floundering around sideways right now. Then we look at the advanced decline line studies, and I do show this in every daily video, where we're negative across the board, holding up a little bit better with the S&P. If you look at the moving average, they're all declining, except the moving average for the S&P is at least going sideways. So this is just showing that the S&P is holding up a little bit better than some of the other indexes that are on this chart. We look at traditional Dow theory, which just looks at the Dow and the transports. I also include utilities as part of traditional Dow theory, but a pure Dow theorist would probably not do that. And you're looking for confirmations here, where we're coming down with the Dow. We're actually showing more weakness with the transports, but they're both not doing very well. With the utilities pretty much just going sideways, and they've been holding up better because this is considered more value. Now, the growth area is also in the Dow, but then we have high tech stocks, like Apple, Intel. I think Intel's out. Nvidia is in the Dow now. So they're adding more growth to the Dow, and that can also make it be under pressure when we're going down. And then on Thursday, because we're closed on Friday, United Healthcare, which is the biggest component of the Dow, they came out with earnings. It wasn't well received, and the Dow really didn't have a good day. And we look at a ratio between the Dow and the transports. When this is going up, that just shows that the Dow is outperforming the transports, except in Friday's session because the Dow was under quite a bit of pressure. Here are the transports, which are coming down to the bottom end of this longer term range that we've been in for quite a while. And then this, when it's going down, that means the transports are underperforming the S&P. Now, the S&P has been coming down, but the transports have even been underperforming that. We look at a correlation between the S&P and the transports, pretty strong here. We're up in this red area and near the high end. That means they're going the same basic direction at the same time. Then here's the Wilshire 5000, recent death cross, not looking very good for a broad market measure. This is newer. This is the total US stock ETF. It's now in a downtrend. The low volatility stocks, they're in an uptrend. And these are what money managers and investors do when they're concerned about the overall climate is they get into low volatility stocks like toilet paper and toothpaste. And this is actually holding up a lot better and in a more established uptrend. And when we do a ratio of the low volatility ETF with the S&P, you can see how this is really starting to outperform. Now, if you go back to late 2021 and into 2022, we saw something similar here, and that ended up being a bear market. We don't know if we're going to actually go into a bear market. The S&P, even though it's in a downtrend now, it still hasn't fallen on a closing basis 20% from the all-time high set in the middle of February. If it does that and it's in a downtrend, that would be a defined bear market at that point. Then instead of using the Dow, we say, okay, let's use the S&P instead. And instead of using the transports, let's use the NASDAQ. Not seeing any real strength or divergences here. We break it down a little bit further. Let's use the equal weight, which you notice in 2025, the equal weight Dow, excuse me, the equal weight S&P, it never did make an all-time high. That was in February 19th. And this was a negative divergence with what we were seeing in the weighted version of the S&P. Now, we did set a high here with the QQQs, and that's also a divergence where we're not making a high here, but we were here. But now they're going down more in tandem with each other, with the equal weight QQQs actually going down more. The FANG index, a lot of weakness, not quite into a downtrend yet. ARC, same thing, a lot of weakness, but not really in a downtrend, at least yet. Then all world, when you take out all the US stocks, they're actually holding up a little bit better. They're still in an uptrend. But when we put the US stocks back in and do a ratio, this is in a downtrend. This means US stocks are underperforming the rest of the world stocks for right now. Then this is a longer term chart. This looks at the S&P and then looks at stocks in Europe, Australia, Asia, and the Far East. We're for the first time in quite a while, we're starting to drop below the red line here. And then this is a longer term chart where we're seeing that the momentum, the PPO, is coming down, also showing weakness. And we look at bonds, which had a better week this week than the week before. We were actually going up here based on price, where we were coming down based on price. And the total bond ETF, which did see some weakness, but it's still in an uptrend. Bonds have actually been outperforming stocks so far in 2021. Not quite to an uptrend yet when we look at the Praying World Bond Index. But when we look at a longer term chart, we're falling below this blue line here, which is a monthly chart of the stock to bond ratio. This is a daily chart of all the different yields where we were coming down, then we just shot up really quick. We've been stabilizing a little bit over this past week, and that's been helping stocks a little bit. This is a weekly chart looking internationally. What do we have? We have US and UK rates at the top, then German rates in blue and Japanese rates in red. They've been falling more or less lately. And then we look at the volatility of bonds. That's the MOVE index. They've been quite volatile lately. The VIX, which is we're getting very high readings there. And if you look at the bottom, you can see that there's a pretty strong correlation between the volatility in bonds and the volatility in stocks right now. And it's been a rather difficult environment for stocks anyway. And now we're starting to turn up. This is a daily chart of a bond to stock ratio. When this starts going up, that means bonds are outperforming stocks. Then we look at high yield bonds. These are junk bonds. They're holding up a little bit better. They're still in an uptrend, but they got hit recently too. Investment grade bonds are in an uptrend. These are more high quality bonds, so they're doing okay right now. And then we look at a stock to bond correlation, and we had been neutral here. Now we're starting to drop below this red line. That means they're having a slight tendency to go in opposite directions of each other. And then we are below the rainbow here when we compare junk bonds with more conservative government bonds. And when the market is more risk on, we see this ratio going up. Well, since the beginning of 2025, we're seeing this ratio for the most part going down. That's more negative. Corporate bonds, which are still hanging on to being in an uptrend, nothing really insightful here. I just include this in every video that I do each week just to see if there's anything that we're getting. These are Fibonacci retracements on the 10-year yield. We're in between the lines. We are going up into a higher range with the 10-year yield it's a real departure from what we saw for 40 years. We saw a series of lower highs and lower lows as interest rates kept going down, 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 and then they went to zero down here during the whole COVID mess. Now interest rates are starting to go back up, and we've been maintaining a higher range. Then this is another Fibonacci study here with the 30-year yield. We're in between the lines currently. Then we look at some ratios between the S&P 500 and short-term bonds based on price, and you're going to see a lot of the same thing in some of these charts coming up. We're below the rainbow. That means stocks are underperforming short-term bonds. This is showing that bonds are outperforming longer-term bonds. Longer-term bonds are outperforming stocks. This is a real shift. We were really coming down for the last few years with this ratio, and this is starting to really turn. Then we look at a broad market measure, the S&P 1500, and also compare it with short-term bonds. Another below the rainbow look. Broad market measure, 3 to 7 year bonds, below the rainbow. Tech sector, the 3 to 7 year bonds, below the rainbow. The S&P 500 with the 10-year treasury yield, we're actually starting to see the 10-year yield outperform the S&P 500. Junk bonds, which they're hanging on, they're doing okay, but they were under some weakness here recently too. And then we look at a ratio where that ratio really came down, but this is still in an uptrend. Folks are still favoring junk bonds, even though they're riskier, they get a higher yield with that than with government bonds. If we get to the point where we feel like the economy is really getting weaker, interest rates have topped out and they're going to start coming down, and the Fed's going to come in and start cutting rates, not because they want to stoke up the economy, but because the economy might be really starting to weaken, then we're going to see this ratio really start to come down. But lately, it's really been going up over the last few years. Then we look at a long-term price, a monthly chart here, the 30-year bond. It's still having a tendency to be in a downtrend. And then down below is a ratio between the long-term bond and commodities. This is rolling over, meaning that commodities are starting to outperform. And that could be inflationary longer term. Then I break down the 11 sectors. First, we look at just the sector by itself, where materials are in a downtrend and they're underperforming the S&P, which is also, the S&P has been going down. Materials have been even underperforming that. Communication, this is a growth area, well below the 200-day moving average. We're seeing a real threat to the uptrend, but they're still hanging in there when you compare it to the S&P. It's still, and that's encouraging. That's more positive for the market. Energy, which has just been all over the place, uptrend, downtrend. It's like a roller coaster here. Well, when you compare it to the S&P, it's been underperforming, but lately, if we are turning more defensive, we would expect this ratio to keep going up. If we're doing okay, then we'll probably see this ratio come back down. Financials, and this has been encouraging. They got hit hard too, but now they're at least coming back up to their 200-day moving average. And when you compare them to the S&P on a ratio basis, they're holding up much better. Industrials, starting to see a downtrend here. This goes more with the cyclical nature of the economy, and actually still outperforming when you compare it to the S&P. The tech sector, this is the main growth area. We're in a downtrend now, and we're continuing to see more weakness here, and we're even underperforming when we compare it to the S&P. So even though the S&P has been going down, the tech sector has been going down even more. Then staples, these are toilet paper and toothpaste. And even though they've been getting jacked around lately, they're still in an uptrend, and they're really outperforming the S&P. This has been one of the stronger areas, and that's a concern. As the S&P has been going down, we're seeing this ratio going up, and that, unless this really changes, that is concerning. Then real estate, which of course they were going down as interest rates were going up. Interest rates are coming down, so real estate's going up, but it's still in a downtrend. But on a ratio basis, real estate's actually been holding up better than the S&P. Utilities, which are generally more defensive, but because of all these changes in technology with electric vehicles and AI and the need for electricity, This could also almost be considered a growth area. And then the utilities are really holding up better when compared to the S&P. This is another ratio that I often show in the daily video. When this is going down, that means the S&P is underperforming utilities. In a positive environment, we would see this ratio going up. In a more negative environment, we now see this ratio going down. Then we look at healthcare, which is defensive because you have to have healthcare no matter what's going on in the economy. Kind of weak right now, but holding up better when you compare it to the S&P 500. Then we look at growth stocks versus treasury bonds. We're just about getting ready to see a death cross here. This is a real shift in the overall tone of the market, where when we were really going up, this ratio was really going up. That's now under pressure now. And the tech sector to the 10-year yield shows that tech is underperforming. This is showing how the 10-year yield is outperforming. It's in an uptrend compared to the tech sector. And discretionary to staples. This is now in a downtrend when we do a ratio here. When we look at staples to discretionary, staples are now in an uptrend, just an inverse of what I just showed. This also shows how discretionary is holding up. It still has an uptrend here, but man, this is not performing all that well. And this includes Amazon and Tesla, are two big stocks that make up discretionary. Starting to get really close to a downtrend here, a death cross with discretionary. Then energy to the tech sector, just showing how energy is now starting to outperform tech after a couple of years of tech outperforming energy. Gold has been going up as the S&P has been going down, so we're seeing this ratio go up, and gold has been going up as the dollar's been going down. High leverage loans, now this could be somewhat encouraging because they got hit with everything else. They're coming back up and they're getting a little bit back above their 200-day moving average. Now, we're not quite in a downtrend yet. We're still hanging on to an uptrend, but this is another barometer of the economy. This is showing some weakness now. If this continues to go down, this could suggest that the people that are in high leverage loans, they're very risky. They're starting to get nervous, and the value of this ETF could continue to fall. If it comes back up, then that would give us more confidence. So copper is suggesting that the economy is looking okay. This chart is not falling off a cliff. It got hit, but it's showing some improvement. But if this starts to go down, then that's a contradiction between high leverage loans and copper. One of them will probably have to shift to either an uptrend or a downtrend. And the NYSE composite getting close to a downtrend here. This had been hanging on and doing better, but it's even been under weakness lately. All stocks getting really close. That's US and international stocks, just barely hanging on to an uptrend. Emerging markets starting to see a downtrend here. The Japanese Nikkei, which came up to this previous all-time high and has just jumbled around here for quite a while and is now starting to fall down. Bitcoin is now in a downtrend. Micro caps, really small stocks on a comparative basis. This is now in a downtrend. And we're seeing it's more neutral now when we look at the top, which is the S&P 500 and the home builders ETF, which has been under a lot of pressure. And when we see a real opposite reading here, that's when I mark it in yellow. We're not really seeing anything right now. It's more of a neutral correlation. Then if we go back to the beginning of 2025, gold is doing the best, followed by the price of bonds. And then the purple line, that's a new addition. Those are commodities. They're barely positive. The green line is the dollar, the red line is oil, and the black line are stocks. They're the worst performing asset class so far in 2025. Then we look internationally. China is in a downtrend. The emerging markets are in a downtrend. Europe, Japan, yes, it's like a global downtrend right now. And this uses the KST, which is a longer term momentum oscillator. Then we look at some correlations, stocks versus the dollar, slight tendency to go in opposite directions. And stocks to oil, after going in the same basic direction, we're seeing that correlation really start to come down a bit here. And then tech to the 10-year yield, they're having a tendency to go in the same direction. So they're both either going up or down together. And then stocks to the 2-year yield, pretty strong correlated relationship there. They're tending to go in the same direction. And then the S&P to the 10-year yield, they're also going in the same basic direction. Then some long-term charts. This is a monthly chart of the NYSE. We're falling underneath the red line, which is a 12-month moving average, and we're rolling over with the Copic curve. This is suggesting that the long-term trend is weakening. This is a daily chart with the NYSE record high percent index. This has been coming down. That's negative. We look at a monthly chart of the S&P, starting to fall below its 12-month moving average. And the PPO, which is a momentum oscillator, right at the beginning of 2025, it started to go down. And this is showing longer-term weakness. And then we look at the S&P on top, and we do a ratio between stocks and commodities, similar to what I showed before, but this is longer term. This ratio is going down. That means stocks are starting to underperform commodities on a longer-term basis. And then we look at another global measure here, the S&P to the global index. Coming right down to the moving average, the KST, which had been positive, is now starting to come down, but it hasn't quite crossed below the moving average. So then at the very end, I look at those things that are positive. And my definition of positive is when the 50-period moving average is above the 200. Now, the value indexes are still positive. The copper, that's positive. Now, the US dollar, I should have changed that. That's in a downtrend now. And then the yen against the dollar, the yen's actually outperforming. CRB index, gold, silver, the FANG index just barely hanging on to an uptrend, ARC. And a lot of these, if we have another down week, these will probably all go over to the negative side. And then we look at the low volatility ETF. That means the market's getting more defensive. Staples, that's defensive. And then we look at bonds, the total bonds, the high yield bonds, investment grade bonds, corporate bonds, and junk bonds. The tech sector, which again, I thought I checked this. That's in a downtrend now. That should be on the next slide. High leverage loans, they're hanging on to an uptrend. The Dow, okay, there's a mistake. I should have changed this. The Dow is now in a downtrend. The NYSE composite still hanging on to an uptrend. The NASDAQ 100 is now in a downtrend. All stocks still hanging on barely with an uptrend. And now I thought I updated this, but these are the negative things. So we have the growth indexes are now on the negative side. The mega caps are negative. The euro, the British pound, okay, that's starting to change. I thought I did a good job of updating this, but apparently I didn't. The Dow Jones Composite, that's turning more negative. And semiconductors, whether you look at the SOX index, ETFs, or indexes, they're all going down. And the World Bond Index just barely still just off of being in an uptrend. And the NASDAQ mid caps, small caps, and micro caps are in downtrends. The Wilshire and the total US stock ETF, that's broad market, negative. Emerging markets are still just hanging on to being negative there. Bitcoin is also in a downtrend. So thank you. And I'll go change this so that I thought I went through and did that. But I hope you found this helpful. I do this video every week, and feel free to check it out and see if you find it useful for making decisions. So I will talk to you in the next video.